Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always do your own research and consult with qualified professionals before making investment decisions. Welcome back to Understanding Money. Today, we're building something amazing together, your very first investment portfolio. If you've been putting off investing because it feels overwhelming, or you're stuck wondering, where do I even start? This guide is for you. We'll walk through everything step by step, setting your goals, choosing your first investments, balancing risk and reward, and creating a plan you can stick with for years to come. Grab a notebook, get comfortable, and let's build your financial future together. Don't forget to like this video and subscribe for more practical money advice. Step 1. Get your financial house in order. First, before we dive into exciting investment choices, let's make sure your foundation is solid. Think of this as building a house. You wouldn't start with the roof, right? Emergency fund. Do you have 3-6 months of expenses saved up? This isn't for investing, it's your safety net for life's surprises. Keep this in a high-yield savings account where you can access it quickly. High-interest debt. If you're carrying credit card debt at 18 to 25% interest, pay that off first. No investment consistently beats those kinds of returns, so tackle the debt before building your portfolio. Employer match. If your company offers a 401k match, contribute enough to get the full match. It's literally free money. Don't leave it on the table. Once these boxes are checked, you're ready to start investing. Step 2. Define your why and timeline. Every great portfolio starts with clear goals. Ask yourself, what are you investing for? Retirement, a house down payment, financial freedom. When do you need this money? Next year, in 10 years, in 30 years? How would you feel if your investments dropped 20% tomorrow? Your answers shape everything. Saving for a house in 2 years? You'll want safer, more stable investments. Building retirement wealth over 30 years? You can take more risk for potentially higher returns. Write down your main goal and timeline. We'll refer back to this as we build your portfolio. Step 3. Understanding asset classes. Your investment building blocks. Let's break down the main types of investments you can choose from. Stocks, equities. When you buy stock, you own a tiny piece of a company. Stocks offer the highest long-term growth potential, but come with more ups and downs. Perfect for long-term goals. Bonds. These are loans you make to governments or companies. They pay regular interest and are generally safer than stocks, but with lower potential returns. Great for stability and income. Real estate investment trusts, REITs. These let you invest in real estate without buying property directly. They often pay good dividends and add diversification. Commodities, things like gold, oil, or agricultural products. They can hedge against inflation, but tend to be more volatile. For most beginners, stocks and bonds are your bread and butter. Step 4. The magic of asset allocation. Asset allocation is just a fancy way of saying how you divide your money between different investment types. This is arguably the most important decision you'll make, more important than picking individual stocks or funds. Here are some common allocation strategies. Aggressive, 80% stocks, 20% bonds. For younger investors with 20+ years until they need the money. Higher potential returns, but expect some bumpy rides. Moderate, 60% stocks, 40% bonds. A balanced approach that still offers growth potential with more stability. Conservative, 30% stocks, 70% bonds. For those nearing retirement or who need more predictable returns. Age-based rule. Some folks use 100 minus your age for stock percentage. So, a 30-year-old might hold 70% stocks, 30% bonds. Remember, there's no perfect allocation, just what works for your goals and sleep at night factor. Step 5. Choose your investment vehicles now. For the fun part, how to actually buy these investments. You have several options. Index funds and ETFs. These are baskets holding hundreds or thousands of stocks or bonds. They're diversified, low cost, and perfect for beginners. Instead of picking individual stocks, you buy the whole market. Popular choices. Total Stock Market Index, like VTI. S&P 500 Index, like VOO. International Stock Index, like VTIAX. bond index, like BBND. Target date funds. These automatically adjust your allocation as you get closer to your goal date. Pick a fund with a date near when you'll need the money, and it handles everything else. Individual stocks. Picking specific companies is riskier and requires more research, but some people enjoy it. If you go this route, keep it to a small portion of your portfolio. Robo-advisors, services like Betterment or Wealthfront, build and manage diversified portfolios automatically for a small fee. For most beginners, I recommend starting with index funds. They're simple, effective, and time-tested. Step 6. Open your investment accounts. You'll need somewhere to hold your investments. Here are your main options. Taxable brokerage account. You can invest any amount and withdraw any time, but you'll pay taxes on gains and dividends. Good for general investing. Traditional IRA. Tax-deductible contributions, but you pay taxes when you withdraw in retirement. Great if you expect to be in a lower tax bracket later. Roth IRA. You pay taxes now, but withdrawals in retirement are tax-free. Perfect if you expect to be in a higher tax bracket later or want tax-free growth. 401k through work often comes with employer matching and higher contribution limits. Many people use a combination, maybe max out retirement accounts first, then use taxable accounts for additional investing. When choosing a broker, look for low or no fees, good selection of low-cost index funds. User-friendly platform, strong reputation. Popular options include Vanguard, Fidelity, Schwab, and many others. Step 7. Start simple with a 3-fund portfolio. Here's a beautifully simple portfolio that many successful investors use. Fund 1. Total Stock Market Index, 60%. Gives you ownership in thousands of US companies of all sizes. Fund 2. International Stock Index, 20%. Adds global diversification with companies from developed countries worldwide. Fund 3. Bond Index, 20%. Provides stability and steady income. That's it. This 3-fund portfolio gives you global diversification across thousands of companies and bonds, all with rock-bottom fees. As you get more comfortable, you might add a REIT fund for real estate exposure or increase your international allocation, but this simple mix can serve you well for decades. Step 8. Automate your success. The secret sauce of successful investing isn't picking the perfect stock, it's consistency. Set up automatic monthly investments so you're buying regularly, regardless of what markets are doing. This approach, called dollar cost averaging, means you'll buy more shares when prices are low and fewer when prices are high. Over time, this tends to smooth out the bumps and reduce the impact of trying to time the market. Start with whatever amount feels comfortable, even $50 or $100 per month adds up over time. You can always increase it later as your income grows. Step 9. Monitor and rebalance, but not too often. Your portfolio needs occasional tune-ups, but not constant tinkering. Once or twice a year, check if your allocation has drifted from your target. For example, if stocks have a great year, your 60% stock allocation might grow to 70%. Rebalancing means selling some stocks and buying bonds to get back to your target 60-20-20 split. This forces you to sell high and buy low, exactly what you want to do. Resist the urge to check your portfolio daily. Monthly or quarterly is plenty. Remember, you're building long-term wealth, not day trading. Step 10. Common beginner mistakes to avoid: trying to time the market. Nobody can consistently predict short-term market movements. Time in the market beats timing the market. Chasing hot performance. Last year's best-performing fund is rarely next year's winner. Stick to your plan. Emotional investing. Markets will have bad days, weeks, even years. Successful investors stay calm and keep investing through the storms. Over-diversification. You don't need 47 different funds. Simple often works better. Ignoring fees. A 1% fee might not sound like much, but it can cost you hundreds of thousands over decades. Choose low-cost options. Analysis paralysis. Don't let perfect be the enemy of good. Start with something simple and adjust as you learn. Step 11. As you grow. Advanced considerations. Once you're comfortable with the basics, you might consider tax loss harvesting, strategically selling investments at a loss to offset gains and reduce taxes. Factor tilting, adding small cap or value funds based on historical premiums. Individual stock picking, if you enjoy research and understand the risks. Alternative investments, REITs, commodities or other assets for additional diversification. International bonds for currency diversification. But remember, fancy doesn't always mean better. Many millionaire investors stick with simple index fund portfolios their entire investing careers. Step 12. Your action plan. Here's what to do after watching this video. Calculate your emergency fund needs and start building it if you haven't already. Define your main investing goal and timeline. Choose your target asset allocation based on your timeline and risk tolerance. Open an investment account with a reputable low-cost broker. Pick 2-4 broad index funds that match your allocation. Set up automatic monthly investments to keep things simple. Mark your calendar to review and rebalance annually. Remember, the best portfolio is the one you'll stick with through good times and bad. Start simple, stay consistent, and let compound growth work its magic. Conclusion and your next steps. Building your first investment portfolio doesn't have to be complicated. Focus on the fundamentals. Clear goals, broad diversification through low-cost index funds, and consistent investing over time. The most important step is the first one. Don't wait for the perfect time or until you have more money. Start where you are with what you have and keep learning as you go. I'd love to hear about your investing journey. Drop a comment about your goals, questions, or what's holding you back. And if this guide helped you feel more confident about investing, hit that like button and subscribe for more practical financial education. Thanks for spending time building your financial future with me. Here's to making your money work as hard as you do. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always do your own research and consult with qualified professionals before making investment decisions.